Thank you so much, sir, for joining us here tonight. Thank you, Shireen. And now, ladies and gentlemen, it's time for the first panel discussion titled Filling the Credit Gap to Fuel Economic Growth. In the pursuit of robust economic growth, addressing the credit gap remains a critical challenge. As India continues its journey towards becoming a global economic powerhouse, the ability to provide adequate credit to various sectors is crucial for sustaining momentum and driving inclusive growth. To delve into strategies and solutions aimed at effectively filling the credit gap, I would request Latha to kindly come back up on stage. I would also like to invite the panelists for this session. Please welcome A.K. Tewari, Managing Director, State Bank of India, Prashant Kumar, Managing Director and CEO, Yes Bank, and Ashok Vaswani, Managing Director and CEO, Kotak Mahindra Bank. Over to you, Latha.
Mr. Tewari, Mr. Kumar and Mr. Vaswani, thank you very much for indulging us. Banking, never a dull moment. And the Deputy Governor has already given us some leads into how the regulator is thinking. Actually, taking a cue from what Mr. Swaminathan said, let me start there. He said we are in a high part of the cycle. Everything moves in cycles, so does finance, and we are at the high point of the cycle. So let me start with that question itself. Are we past the high point, Mr. Tewari?
So I would say finance is a derivative industry. It's not on its own. So if the underlying industrial cycle is on a downswing, finance might also come to a downswing. And as long as we see the underlying cycle is still going up, I don't think we are going to go down at this point.
Well, at the moment, I can tell you that the GDP is at 6.7%. The Q1 GDP is the lowest in 5 quarters. It is lower than the previous quarter, lower than the year ago, same quarter. It was 8.2. Previous quarter was 7.8. At 6.7, we are at the slowest in 5 quarters. So, anyway, separately, I mean, we've got a very good NPA number for the industry at 2.8%. I mean, when did we last have it? I think this is historically the lowest GNPA that the banking sector has had, which is why I'm asking, is the best behind us?
So it may continue for some more time. Of course, you can say that this number, which is at the lowest in a long, long time, perhaps is too good to last. Okay. Because as things change, then there will be some...
It doesn't get to 2.7 before it goes to 2.9.
We don't know. Okay. That we can't predict those things. But my general sense is, and to your earlier point also, that this cycle, everything is cyclical. But I think the banking system has also learnt its lessons. The underwriting quality has improved. There is also the risk assessment and the appreciation of risk has also improved. I remember in earlier times we would do a project assuming that land will be acquired. No longer. Unless it is 90-95% acquired, we would not disburse anything today. So I mean those kind of examples, a lot of improvement has happened. So I think we are much better prepared to face a cycle as and when it arises. Things would be much better than previously.
Well, I must just tell our esteemed audience, you already know, that until now, the 3 people who have spoken are all SBIites. I mean, we had Mr. Swaminathan, and then we had Mr. Khara, then we had Mr. Tewari. So I'm going to skip Mr. Kumar for the moment. That will be a 4th SBI. So let me pose the question to Mr. Vaswani. What is your sense? I mean, we are seeing a rise in MFI loans going NPA, trouble with them, trouble with unsecured loans. A lot of credit card loans are seeing trouble. So do you think we are just past the best? Instead of the banking sector going to from 2.8 to 2.7, do you think that we have bottomed out in terms of NPAs and now we are going to see a rise in risk?
Latha, I like the comment that I think Mr. Khara made, which is the best is yet to come.
Okay.
And I don't think there's a doubt about that. I think, look, at the end of the day, these things do move in cycles, but for the long term, is the banking sector in India in a much, much, much better position than it has been in a very, very long period of time? That's absolutely true. I think the banks have understood and learned how to deal with these kind of situations. The regulators actually have done quite a remarkable job of kind of managing it. Yes, there will be some kind of ups and downs. This cannot be just, 2.8 is not going to become 2.6, 2.4, 2.2, 2, 1.8. There will be ups and downs, but I generally think the banking system is in very, very good shape.
Okay, let me put it this way, Mr. Kumar. This is a crowded trade. I mean, time was when people competed in terms of corporate and infra lending. Now, there is a complete migration to retail, and to add to it, you already have NBFCs, the likes of Bajaj Finance and MMFSL and, the Srirams of the world who are already in retail, and you have fintechs, the kind of the neobanks. So it's a crowded trade. So do you think we are reaching a stage where we are bound to see more NPAs? Maybe you have the money to provide for it. I'm not taking that away. Your NNPAs may be the lowest, but are we going to see an uptick in unsecured loans at least going bad?
No, I think we need to see in terms of what are the opportunities available. When you are talking about a crowded train, I think we should not restrict in terms of like train is having only 10 bogies, each bogie is having 90 seats. We are talking of 140 crores Indians. And I think we were also talking about some numbers we are giving. If you see the coverage for our population, which are part of the formal credit, is a very, very small as compared to any other geography. So I think the opportunity which lies is sufficient for everybody, whether we talk about banks, NBFCs or the fintech. I think important thing would be how to reach to the last mile. And I think this is what banks, fintechs and NBFCs are attempting to do together.
So it's not as if you're lending more to the same person, you're lending to new to credit people.
More bogies keep getting added.
I take your point. It's no longer 10 bogies. I take your point on that. But actually, let me expand on that point. The other issue which, the other abbreviation which has now become very popular with the Reserve Bank is not UPI but ULI. Ms. Tewari, where do you think we are on ULI? Do you think we are very close in the sense, has a lot been digitized? How are the account aggregators doing? Are we getting into ULI in a few months?
So ULI, I really can't comment because basically it's based on the platform which has been set up.
You all will be involved in the
No,
platform.
we are involved. So there is the platform already set up by RBI on which the Kisan credit card was launched, as the governor was explaining. So that's the pilot kind of stuff. This has been done. That was pretty smooth and pretty good. Now, when we want to bring in all kinds of loans, then there could be some different shades. So we have to see how that goes. But my sense is that this would be a good platform for low ticket, large volumes, and with information which is integrated across, because one of the challenges we face currently, that for example, GST has been touted as a initial this thing, but we need a consent every single time, which means an OTP on the borrower's phone. And that's a very practical difficulty which we face.
No, but when the borrower wants money, would he not check the box in terms of you can access my GSTN?
Yeah, only one time.
It's not smooth.
One time.
Okay.
So once he consents, that means he tells us the OTP, we will be able to do that. But we need to monitor these loans all the time.
Oh, okay.
So it has to be a continuous thing. I mean, in our regular...
So at the moment that is not in place?
No, it's not there. It's not there. This is something we've been taking up with the authorities.
So when he wants the loan, he gives you the consent. But when you want to monitor the loan, he is not giving you the consent.
Consent means the OTP every time. Okay. That's a consent, byword for consent. So that's those kind of things, some of those have been solved in this platform. Okay. Because there is, if these kind of enablers
the repeat consent is solved in the platform.
Solved in the platform for the time being, and now we have to see what more can be done. There could be other things also which are being thought about. And if all of these things are done, then I think it would be a very good platform for a very basic platform for low ticket, large volumes, and at the base of the pyramid, which is a high cost item.
So you see it as for personal loans, SME loans?
Yeah, I mean, all I'm saying is for people who do not require very large amounts of money, small ticket, like we have all these fintech platforms, the repeat loans, etc. This can all transit easily here. And the other thing is that since it's a Reserve Bank-led thing, the trust and the confidence in this platform will be pretty high. The data will be used exactly for the purpose it is meant for and not used for other purposes, which currently is the case. And therefore, it can be a very good model. How it pans out, we'll have to all work together on that. We do not have enough details at this point of time.
Actually, that was the doubt that occurred to me also when the governor announced the unified lending interface. There are, what was it, Vivritti or one of those platforms are already available where a bunch of banks look at SME loans,
So
right?
we have multiple platforms. For example, the PSB Online, Loan in 59 minutes is a platform which is
Exactly,
there.
yeah.
And there are 2-3 platforms like this. The only thing is that many of these platforms have different shades.
Okay.
And not everybody has the same enablement. So we have to see how this pans out. I mean, for example, the RBI led the NEFT and the RTGS platforms. And today, we don't even associate RBI. They are very well recognized. So if such a base gets built, I think it will be good for the industry overall.
Okay. What's your sense, Mr. Vaswani? Do you think we are very close to having this kind of a platform? The RBI seems to be of the view that if you are a SME and you're bidding for a loan, you just get onto that platform and various banks can actually bid for your loan. That's the end game they're looking at. Is that anywhere close? Since we are talking banking transformation, how far is it, you think?
See, Latha, I think India's public digital infrastructure, which has been built, is unparalleled. I have not seen anything like this anywhere in the world. Anywhere in the world. Okay? And it continues to progress at a dramatic pace, right? Now, there's lots and lots of good things about it because it leads to the democratization of availability of finance, which is a good thing. I think we will have, it obviously leads to greater competition. So therefore, the banks will have to learn how to compete in this new area of heightened competition. I think the bankers will have to learn new skills, how to leverage data, how to leverage technology, right? When I started, if you were a chartered accountant, you know, you were golden for a bank, right? Right now, I guess an engineer is more golden for a bank because those are the people who can actually build these kind of systems. So these changing skill sets, these changing kind of demands on banks is going to happen, right? In general, this is only a good thing. Of course, we've got to be a little careful because these systems are also exploited by the bad boys, and you can hear about digital frauds, and you hear about, you know, scams and stuff like that. But we then as bankers have to figure out ways, right, where we can really take advantage of this. Every single element of it may not be ready today, but it's a matter of time. And I think we're marching ahead to a very, very exciting kind of future for financial services.
No, that point is taken that both our public infrastructure, digital public infrastructure, and the fact that we are marching ahead in terms of inclusion at a pace which we would never have thought would have been possible.
I'll just make a very quick point. Actually, for a country like India with so many people, we need multiple digital public infrastructure platforms. So one is to have the ease across all these, and second, more importantly, from a cyber security point of view also,
It's just as well that we
each
have.
is a BCP for the other.
Okay, it's just as well that we have private platforms as well as an RBI-sponsored platform. But what about the cost, especially when it's not a large bank, Mr. Prashant Kumar? An ex-city banker had said that I am only a technology company now with a banking license. It's come to that. Every bank has become a technology company. Do you think small banks can continue in the fray given the kind of regtech and subtech that you all have to put in?
No, I think the issue would be whether you have the right kind of solutions. Okay. Technology always comes with the cost, but also in terms of efficiency of doing very large business within a small entity. So I think depending on adoption for the right kind of technology, you continue to need to invest, but also it helps in terms of efficiency.
Do you think there is a space for small banks as well? Or do you
Absolutely.
think just everyone has to merge because of the economies of scale of technology?
No, economies of scale is one part. But I think in terms of your ability to move very fast, I think that lies with the small institution.
Okay.
You become very large, and then there is your speed becomes slow.
Okay.
Latha, I
I
take
take your
actually a different view on that because I'm saying instead of merging or having to become a big bank, today with the technology infrastructure that is available in the public space, right? With computing costs going down, with ability to do things on the cloud, with risk analytics, your ability to actually set up a bank with far less infrastructure is much, much, much easier.
I think your
And in
point-
fact, you've seen it in the technology space. You look at the US, every of these small technology companies have started and scaled, and look at the valuations they've got.
I take your point. I mean, that's one reason why India could leapfrog. We did not have to scratch out a legacy system. I mean, we started off with state-of-the-art. I take your point on that, but still technology costs seem to be mounting so much that sooner or later, perhaps the bigger boys have an advantage. But let me come to the hottest topic of the day, deposits. What's your sense, Mr. Tewari? Do you think costs have to go up before they go down? The rate at which people are, competing for deposits, even warring for it.
So warring is a very strong word, but deposits, there is clearly a competition, because if every bank wants to fund its credit growth, and traditionally India has had always 90% of the loan growth has been funded by deposits. If that be the case, clearly as loan growth outpaces deposit growth, at least for the near future, there will be a challenge on deposits, and therefore as a natural corollary the rates might go up, and they have been going up in different buckets depending on each bank's own this thing. As far as we are concerned, as you know, we are still below 70 in the last quarter in terms of CD ratio, so we don't have that much of a challenge. But at the same time, deposit is always a franchise. So you can't say that we'll stop gathering deposit right now. It has to continue. The relationship has to continue. And therefore, my sense is costs might go up a little in the short term, but ultimately it will all stabilize, and then we will have the usual revert back to the normal as it was some time back.
Is it a given that for the industry, margins will come down in the coming quarters because the cost of the raw material is shooting?
So as the deposit cost goes up and the loan prices do not go up as much, because they are already at quite a peak, and therefore
You have another problem. Your loans are benchmarked to T-bills and they are not rising.
T-bill, MCLR, so T-bill is actually coming down. Without the
Yes,
rates
exactly.
being cut, the T-bill rates have gone down by 40 basis points in the last 1 or 2 months.
So for the sector, you think...
So for certain shades, yes, the margin would reduce, and therefore we have to find out new areas, new avenues where we have to protect the margins overall, and also surround services. It cannot be only lending and deposits. It has to be a complete banking bouquet, which will add to the bottom line ultimately. That's what it matters.
What's your sense, Mr. Kumar? Do you think for sure, I mean, the market is screaming, it's pushing up all stocks, but Bank Nifty is the last to rise. So do you think that we have to reconcile to lower margins in the coming quarters?
No, I think first we need to see this issue about this deposit, which I think we are talking about.
Yes.
I think first we need to understand what is the ground reality. Data shows that the industry deposit growth is around 11%,
Yeah.
as compared to 13% which was happening last year. I think it's important to appreciate why this is happening. Okay. First, there was a lot of deposit which was sitting in the banking system because of the inefficiencies in the government functioning, which has improved a lot. Now, with the kind of efficiencies which has come to the government systems, I think the surplus money which was there in the entire banking system
He's
has
sitting
moved
with the government now.
has moved out. So there is always inefficiency.
No, they have 4 lakh crore. I mean, maybe it's
Whatever.
a little less now.
The
But
second part-
unspent government money is
Yes.
very much a problem.
The second part in terms
The
of when the
RBI, not
regulation has come in terms of you can't open a current account with a non-lender. Okay. Now what is happening that the money which was parked in the current account with some a non-lender is actually now moving into the cash credit of the lenders. So that surplus money is also not there. The third part in terms of the household savings, okay, which was coming to banks, now either they are getting invested in some other assets, productive assets I would be saying, and also for some high earning assets. This is the ground situation. If the deposit growth would not be equivalent to what was happening earlier because of these major things, I think it is important that how you expect from the banks. Okay. What I am saying, there was a discussion in terms of that ultimately any money which is coming to mutual fund would come back to bank.
Exactly, it is
No.
in the banking system.
No, it's not like that. Money would not come as a retail deposit. Money would come as a
In the current account of the mutual fund.
wholesale deposit. But you are actually monitoring the banks in terms of what is the contribution of the retail deposit. What is the contribution of the bulk deposit? I am only saying if these are the changes which are happening, we need to monitor the banks from a slightly different angle. Why there should be so much dependence only on deposits? A bank in terms of
So you
liabilities.
see the CD market booming.
No, it's not only CD. There are borrowings. I am saying there has to be a combination of deposits and borrowings, which takes care of your loan growth. And similarly, your expectation in terms of how much is coming from retail or wholesale is a difference. Now, if you see the money which is coming to mutual funds, they would not be parking in the current accounts.
Yeah.
They would be doing the liquid funds, which are investing in the GSEC. So it is not like everything is coming to the banking
Banking
sector.
system. Okay. No, I take your point over there, but you've almost agreed that there is going to be a pressure on margins.
No, I'm not saying that. I'm only saying the deposit, something this is what the industry would evolve. Okay. Everybody would understand this is how the structure would change.
Okay, I take your point on that, but still, the second largest bank is giving 8.2% for a 100-day deposit. So, on that point, Mr. Vaswani, isn't it inevitable that your raw material cost is really going through the roof, and therefore we have to be prepared for low margins?
See, look, the way I look at it is these things happen in cycles, and there are multiple cycles that are at play here. I think he made some very good points around how the government has become far more efficient in managing their money. Obviously, we are seeing a cycle with the individual customer, that the investments into capital markets is kind of going up. Eventually, these things will find equilibrium. So will there be a quarter, 2 quarters, 3 quarters of some kind of disruption? We're already starting to see that. So that is not new news to anybody, right? That will continue, but eventually some kind of equilibrium will kind of come up, and market forces will force it. Right? Everywhere in the world that you see, how much ever, as a country develops, the balance sheet of banks change. There is no question about that. And that is something that we are going through, and that will continue to go through. So this is to my mind, it's a cyclical kind of
Cyclical and not transformational. So let me use the last 10 minutes that we have for transformational questions. Okay, one of the things I wanted to ask, okay, let me start with you on this issue. Are bank branches becoming a thing of the past? I mean, do you think that the hunger for more branches may not be there because we've become so digital?
So I'm a very firm believer that there is a solid place for branches. Okay? There is a solid place for branches. What may change is the quantum of branches that you required.
Maybe the size of the branches.
The number, the size, what happens in a branch, and what you use a branch for. All of that may change, but the need for a branch still changes. How much ever we talk about Gen Z and millennials and stuff like that, for complicated financial services product, there's always a need to have a conversation. We saw in COVID also, at the end of the day, a person-to-person conversation is always preferred to a kind of call conversation. So there will always be a need for branches. The quantum, the size, what happens in a branch will change.
Okay, what's your sense, Mr. Kumar? Branches have not gone out of fashion?
No, absolutely not. Because ultimately it is about the depositors. I think the confidence of a depositor in any bank would come if they are able to see the physical presence of a branch. But I think the format of the branches have changed. Maybe earlier we were talking about a 5,000 square feet branch with 20 people. Now you are opening branches with 800 square feet, 1,000 square feet with maybe 4 or 5 people. Because maybe 90% plus transactions are happening on digital, the entire customer acquisition. But I think for a depositor to have a confidence that this bank is there, and if there is a problem, there is an outfit where I can go and my problem can be addressed. So I think it is important to have a adequate branch network in the entire area, the formats would change, the cost would come down, and it would be more in terms of troubleshooting and some of the sales.
I'm not asking that question to the man who anyway has the largest number of branches.
No, I'll just add.
Is there a district where there's no SBI? I doubt it.
No, there is none. But in addition to the 22,500 branches, I would argue that we also have 82,000 points of presence as the business correspondent model. I think this model is also extremely important as we go along, and we are looking to enhance and strengthen this model, because for not only small value transactions, but multiple other services which they can offer. We already offer 32 services from those. So I think we are more than 100,000 branches, if you would call in that sense.
Fair point, fair point. There are other ways in which you'll have cyber branches probably. Okay, I want to use the last 5 minutes for a rapid fire, but just one more transformational question, and let me start that with you. We are seeing finally India getting long-term pools of capital. Bank deposits are growing at 11%, but insurance plus pension money is growing at nearly 20%. And the total kitty now is 115 lakh crore, not very far behind the 200 odd lakh crore, which is bank deposits. Plus, you have this large amount of, global money because of India's bond index inclusion. Do you think we are on the cusp of a corporate bond market evolution? Because there's so much of, longer term money sitting, do you think corporate bonds will be able to finance infrastructure? You see it happening?
That's the hope, because in every developed market and every other market which has had a lot of infrastructure growth, corporate bond market has played a very, very important role. And in general also what we have seen is that banks may fund the initial project, but as the project comes on stream, starts to generate cash, then it gets taken out by the corporate bond market. So that's clearly the hope, but I think a lot of work needs to be done still in terms of the bond market as it stands today, so that the less rated corporates, because today AAA and AA is all that is able to raise money easily. The double Bs, triple Bs and all don't. And my sense is, I always compare that if you can lend to a single B or a double B, then what prevents for the bond to come in and we can invest in the bond as well. But a lot of work needs to be done across regulation, across pricing, across rating, and various other things like these pension funds and the insurance you talk about. Most of them don't have a mandate.
They won't go below AA.
Yeah, yes, exactly. So if they are not allowed to go below AA, then how do you think that bond market is going to develop? So much work needs to be done. But it's getting there. It's getting there.
Okay, the rapid fire I start, the first one is not too rapid. I want each of you to give me one sentence on what is your idea of transformational banking. 5 years down the line, what do you think will be the one big change in the banking space? May I start with you, Mr. Vaswani?
I think artificial intelligence is going to change everything. And I think that's going to change cost bases. That's going to change the way we interact with the customer. I think that's what's going to drive a lot of the transformation.
So your due diligence will change.
Not only due diligence, everything. The way we spot a customer, acquire a customer, service a customer, deal with the customer, everything will change with that.
Okay. Mr. Kumar, your idea of transformed banking.
No, I think it is more in terms of if you can really support the economic growth of the country. That would be the real transformation of a banking or any bank, where it has to be a meaningful contribution in the Indian economy.
Okay. No, I would think that Indian banking already done that, but that is leading me very clearly to the next set of rapid fire. But your idea of transformational banking, so how will banks look 10 years from now?
So this is a wacky question. Banks would look largely what you see today, but my idea is a bank in a pocket. So all the mobile, everything, and it should not only be go into the app and do everything, just speak to the bank, mobile,
Fair
and
point.
things get done. So we have to reach that, because otherwise we have a lot of people outside. The smaller phones, the feature phones, they don't participate in the digital banking.
In that case, you guys will not give us off-the-record statements at all, because it's always on the record somewhere. Okay, the other rapid questions I want to ask you. What do you think is going to be the bank credit growth over the next 3 years? What's the average, you think?
Are you asking me for a
Yes,
percentage?
that is the rapid question.
Look, banking sector grows at about 1.5 times GDP growth. That's usually where it goes. So you
tell me what is the GDP growth as well. Are you forecasting 7? Are you forecasting 8? Are you forecasting 6?
So I'm not an economist.
Okay.
Far more superior people can be economists and tell you that. But I think we should peg it at about 1.5 times GDP growth.
But in that case, you're saying that it would be more like what? You take nominal GDP growth, so say 10% GDP growth, you would expect only a 15% credit growth?
So on the margin, I mean, the industry goes at about 15. There'll be people who will go slightly lower, slightly higher.
Okay. What's your sense, Mr. Tewari? I'm trying to dodge.
This is really rapid. But my sense is anything between 15 to 18%.
Yes.
Yeah. Because so much is happening. I mean, all those, you talk about retail, but there's so many people coming into the banking system. There's so much of industrial growth happening, so much of push on all sides, 15 to 18.
Okay. Mr. Kumar?
So I think if we aspire to be a $10 trillion economy by 2030 and Viksit Bharat by 2047, I think the credit growth has to be in the range of at least 15%.
Okay.
Now, whether it is coming from the banks only or from the bond market, I think my answer would be a combination of both.
Okay. Well, I think we'll have to call it a day. There is a very important NBFC and FinTech panel also waiting by. Thank you very much, Mr. Tewari, Mr. Kumar, and Mr. Vaswani. I think for me, the big takeaway is that banking is going to be in your pocket, but branches are not going out of fashion, and Indian banking is prepared for a 15 to 20% growth. On that note, thank you very much.
Thank you.
Thank you so much, Latha. Thank you, Mr. Tewari, Mr. Kumar, and Mr. Vaswani for joining us here tonight. Well, it is time for another fireside chat this